Well, I've been doing this investing game for over 80 years now, starting with my paper route earnings when I was just a boy. Uh, I picked up my first stock, City Service Preferred, at age 11, paying $38 a share. It went down to $27, then back up to $40, and I sold it for a small profit. What a bonehead move that was, because it soon shot up to $200. That early lesson in impatience, it stuck with me, but it wasn't the biggest, most expensive lesson I had to learn, not by a long shot. The truth is, my biggest mistakes weren't about missing opportunities. They were about making bad decisions, usually driven by emotion. Back in the early 1960s, I made one of the biggest capital allocation mistakes of my life, one that, if you count the opportunity cost over the decades, probably cost Berkshire Hathaway hundreds of billions of dollars. And it was all because of a stupid emotional decision. I started buying shares of Berkshire Hathaway it was a New England textile manufacturer, a dying business. Plain and simple, like trying to restart a horse and buggy whip factory in the age of the automobile. The company was managed by Seabury Stanton, and he was trying to squeeze out minority shareholders. He made a tender offer for some shares, and I made a verbal agreement with him to sell a block of my shares back to the company at a certain price. But then Mr. Stanton reneged on our handshake deal. He offered a slightly lower price, essentially trying to shave a few cents off the agreed upon amount. Now look, it wasn't a huge amount of money in the grand scheme of things, but I was mad, pure and simple. I was seeing red. Instead of taking the small profit or even just accepting his new, slightly lower offer, I got so irritated that I went out and bought enough shares to take control of the whole darn thing. I bought the entire company just to spite him. What a foolish, emotionally charged decision that was. I ended up pouring good money after bad into that textile operation for years, trying to make it work, trying to make a silk purse out of a sow's ear. It was like trying to teach a pig to sing. It wastes your time and annoys the pig. We closed the last textile mill in 1985, but the capital that was tied up in that declining business for decades, that's where the real cost was. That capital could have been invested in truly wonderful businesses that were compounding wealth year after year. Charlie always says, if you find yourself in a hole, stop digging. And for too long, I just kept digging deeper into that textile hole, all because of an affront to my ego. Here's what I learned from that mistake. Clear as a bell. Price is what you pay. Value is what you get. Ben Graham taught me that, taught me how to buy $1 for 50. But I got so focused on getting a cheap price, a stock that was seemingly undervalued, that I overlooked the fundamental value or lack thereof of the underlying business itself. $1 bought for 50 cents is great, but only if that dollar isn't shrinking in front of your eyes. A fair business at a wonderful price can quickly become a bad business at a fair price if the underlying economics are deteriorating. Charlie Munger, my partner Charlie, you really changed my thinking on this. Ben Graham taught me the margin of safety, which is crucial. But Charlie helped me see that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The difference between a wonderful business and a fair business, even if you buy the fair one cheap, is like the difference between owning a perpetually flowing oil well and owning a bucket of sand. One keeps giving, the other just sits there, or worse, drains your resource. It's like buying a farm. You wouldn't just look at the price of the land per acre. You look at what that land can produce year after year reliably. Is the soil fertile? Is there enough water? Or is it just a barren patch of desert that you got for a song, but it'll never grow anything sustainable? The true value isn't just in the assets, it's in the earnings power, the ability to generate cash and grow those earnings over time. That's the hallmark of a truly wonderful business. The truth is, it's human nature to want a bargain, to chase something that looks cheap. But sometimes cheap can get cheaper, and a dying business stays dying. You don't need to be a genius to understand this. It just takes a bit of discipline and the ability to separate emotion from logic. Investing successfully isn't about having a stratospheric IQ. I've seen plenty of people with 160 IQs fail because they lack the temperament, because they can't control their emotions when the market gets volatile or when their ego gets bruised, like mine did with Mr. Stanton. When we finally understood this distinction, it changed everything for Berkshire. Our investment in See's Candies in 1972 is a perfect example. We bought See's for $25 million. It was making about $4 million pre-tax then. So it wasn't exactly cheap on paper. It was over 6 times pre-tax, but it had a powerful brand, incredible customer loyalty, especially in California, and pricing power. They could raise prices a bit each year without losing customers. That's a wonderful business with a clear competitive moat. And look at Coca-Cola. When we started buying shares in 1988, we invested around $1.3 billion for 7% of the company. It wasn't a net cigar butt deal. We were buying an unrivaled brand, a global distribution system, and a product that brings joy to billions and costs next to nothing to produce. People all over the world, from Omaha to outer Mongolia, drink Coke. That's an enduring business with a moat that would be almost impossible for a competitor to replicate. We have now received more money in dividends from Coca-Cola than our entire purchase price. That's what a wonderful business can do. I've made plenty of other bonehead moves over the years, don't you worry. Dexter Shoes in 1993, that was a real doozy. I used Berkshire stock to buy that shoe company for $43 million. It had a decent history, but what I failed to see was that its competitive advantage, its moat, was crumbling before my very eyes due to global competition and changing footwear trends. Within a few years, it was practically worthless. That was an almost $500 million mistake, not to mention the opportunity cost of the Berkshire stock I issued. It was another painful reminder to understand the business and its enduring competitive strengths or lack thereof before you even think about the price. If you're a young investor today, the single most important thing I can tell you is this: stick to what you understand, define your circle of competence, and then stay inside it. I don't invest in technology companies where I can't understand the underlying business model or predict its future with some confidence. Generally speaking, you won't find me trying to figure out the next tech tests or some esoteric biotech stock. If I can't explain why a business will be earning more money 10 years from now, I don't invest. It's that simple. What I tell my younger self and what I tell shareholders at our annual meeting in Omaha every year is that investing doesn't need to be complicated. You don't need fancy math or elaborate models. You need patience, discipline, and the ability to buy good businesses at sensible prices and then sit on them. Don't let the daily gyrations of the stock market cloud your judgment. The market is there to serve you, not instruct you. It's offering prices for things every day. You only need to transact when those prices are in your favor based on your understanding of intrinsic value. Imagine you own a private business with a partner named Mr. Market. Every day he comes to your door and offers to buy your share or sell you his at a different price. Sometimes he's ebullient and offers a crazy high price. Other times he's depressed and offers a crazy low price. The key is to ignore his mood and only deal with him when it suits you, when his offering price makes sense relative to the intrinsic value of the business. You wouldn't sell your farm just because some manic neighbor offers you too little one day. You just ignore him and go back to planting your crops. This applies to any business, not just investing. What really matters in business is whether you have a sustainable competitive advantage, what I like to call a moat. That moat protects your castle, your profits from competitors. It could be a brand name like Coca-Cola or See's Candies or a cost advantage or network effects. And you want good managers, sensible, honest managers running those businesses. Charlie and I look for managers who care about the business as if it's their own, who allocate capital intelligently, and who tell it like it is, no sugarcoating. We prefer managers who focus on intrinsic value over quarterly earnings numbers and who are exceptional at capital allocation. But that's not the only lesson I learned the hard way, or that Charlie constantly reinforces in my thick skull. While chasing dying textile mills was one misstep, Another was not fully appreciating the sheer power of long-term compounding, especially when applied to a truly wonderful business. This reminds me of another time when I almost let a great opportunity slip through my fingers, all because I didn't hold long enough and then had to buy it back at a much higher price years later. I remember back in 1951, I had just graduated from Columbia, where I studied under Ben Graham, the father of value investing. I was 20 years old, eager, and full of ideas. I had discovered Geico, Government Employees Insurance Company. After reading their annual report, I was so fascinated that I took a train to Washington, D.C. on a Saturday morning, walked right into their headquarters, and met Lorimer Davidson, who later became Geico's CEO. He spent 4 hours with me, patiently explaining the entire insurance business. I was captivated. I immediately invested a huge chunk of my net worth, about $10,282 into Geico stock. It was a massive commitment for me then, and it paid off handsomely, quickly. Within a year, my investment had nearly quintupled. I felt like a genius. But then in 1952, in a move that still makes me groan, I sold it to diversify my small portfolio. What a bonehead move that was. I booked a good profit, sure, but I completely missed the long-term compounding. If I had just held on to that initial $10,000 investment, it would be worth many, many billions of dollars today, tax-free for all those years. That's the staggering power of compounding and the even more staggering cost of impatience and unnecessary transaction costs. It was a small lesson in actual dollars at the time, but the underlying principle became one of the foundational tenets of Berkshire's philosophy. Our favorite holding period is forever. Years later, in the mid-1970s, Geico hit hard times. They had serious underwriting problems, and the stock plummeted from $61 to a low of $2. Everyone thought it was going under. It was a crisis. But I knew the business intimately from my early visit. I knew its underlying strengths, its direct-to-consumer model, its low costs, and I knew management could turn it around. So Charlie and I over at Berkshire started buying it back aggressively. We accumulated a controlling stake, and eventually in 1996, we bought the whole darn thing for over $2. Here's the deal. Compound interest is the eighth wonder of the world. Albert Einstein might have said it, and it's certainly true in investing. You find a truly wonderful business, one with a wide and enduring moat, run by honest and able managers, and you just let time do its work. The longer you hold, the more the magic of compounding takes effect, turning small acorns into mighty oak trees. It's like a snowball rolling down a very long hill. The longer the hill, the bigger the snowball gets. But you need to start with good sticky snow, and you need to avoid hitting any trees along the way. The good sticky snow is the wonderful business, the one that reliably generates earnings and has high returns on capital. And avoiding trees means not getting in and out, not paying taxes unnecessarily by trading too much, and not getting tempted by every shiny new object that promises instant riches. Charlie always says that the big money is not in buying and selling, but in the waiting. He's absolutely right. Most people are too impatient. They want to get rich quick, and they usually end up just getting poor quick. We just sit here in Omaha reading, thinking and waiting for the fat pitches. I spend 80% of my day reading annual reports, financial statements, newspapers, books, and industry journals. It's like searching for a needle in a haystack, but every now and then you find one. And when you do, you don't just throw it back after a quick profit. You hold on to it. That Geico experience and our eventual repurchase became a powerful reminder that if you know a business well and it hits a rough patch, that's often when the best opportunities to buy or buy back arise. Another time when patience and understanding the underlying business paid off handsomely was with American Express in the 1960s. They got caught up in the infamous salad oil scandal, a bizarre fraud involving collateralized loans on non-existent salad oil. Their stock plummeted, and people thought Amex was going to go bankrupt. It was pure panic in the market. Everyone was selling. But I went to their offices in New York, talked to their managers, observed how many folks were still using their credit cards, buying travelers' checks. I went to lunch and saw people paying with Amex cards. The underlying business, the brand, the trust that the consumers had in their services was still there. People just didn't trust the management about the oil anymore, which was a separate issue. So I invested 40% of my partnership's assets, about $13 million, into American Express. It was a massive concentrated bet. We eventually made a profit of over $20 million in a couple of years. It was a stressful time, but it reinforced that when people are panicking and you understand the business, that's often when the best opportunities arise. Be fearful when others are greedy, and greedy when others are fearful. That's not just a cute saying, it's how you actually make money over the long term. When everyone is piling into something, prices get stretched beyond any reasonable intrinsic value. When everyone is running for the exits, that's when you can pick up wonderful businesses for a song. If you've done your homework and understand the business, it requires courage to be greedy when others are fearful, but it's essential for long-term success. The dumbest reason to buy a stock is because it's going up, and the dumbest reason to sell is because it's going down. Emotions are the enemy of rational investing. You need to detach yourself, think like a business owner, and ignore the daily fluctuations of the market. The market is just information, not instruction. It's providing you prices, but it's not telling you what to do. Your job is to think for yourself and act decisively when the facts are clear. This philosophy of patience and long-term thinking also applies to how we run Berkshire. We've always been extremely conservative with debt. I've never borrowed significant money personally for investments, aside from some small margin loans when I was first starting out. And at Berkshire, we maintain enormous amounts of cash. Why? Because you never know when Mr. Market is going to throw a tantrum, when there's going to be a major market torque or a crisis, and we want to have the dry powder to take advantage of it. Cash is like oxygen. You don't notice it till it's gone. What really matters in business is intelligent capital allocation. A company can have a great product or service, but if the management is bad at deciding where to put the money, whether to reinvest in the business at high rates of return, pay sensible dividends, or buy back shares when they are cheap, then you're not going to get good long-term results. We look for managers who are stewards of shareholder capital, who treat it as if it's their own money, and who are disciplined about how they deploy it. But even with all these lessons, it's easy to get fancy, to try to do too much, to chase what's popular. The biggest temptation, especially for smart folks, is to complicate things, to think you need to understand everything. This reminds me of another very important principle, one that's kept us out of more trouble than you can imagine. It's about knowing what you don't know and being perfectly okay with that. For decades, people have asked me why I don't invest in technology companies, and my answer has always been the same. I don't understand them. I stick to what I understand, businesses where I can reasonably project future cash flows with some degree of certainty. I recall back in the dot-com bubble in the late 1990s, everyone, including some very smart people, was rushing into these internet companies. Many had no earnings, no clear business model, just a lot of hype and a promise of a new paradigm. We sat on the sidelines content to look dumb for a while others got rich quickly, at least on paper. Then, as always happens with speculative bubbles, the music stopped, and a lot of those paper fortunes, those high-flying stocks that people thought would change the world, vanished or plummeted. It was a painful reminder that what is fashionable is not always what is profitable in the long run. My refusal to invest in what I didn't understand, even when everyone else was doing it, saved us a lot of heartache and capital. Now, you might point to Apple and say, Warren, you own Apple. Isn't that a tech company? And you'd be right, it is. But my investment in Apple isn't because I understand how their chips work or their software architecture. It's because I understand the incredible consumer loyalty, the ecosystem they built, and the power of that brand. To me, Apple is less about cutting edge technology and more about a profoundly sticky consumer product like Coca-Cola or See's Candies. People love their iPhones. They're practically indispensable, and they pay up for them. They're upgrading every few years. They feel a real connection to the brand. That's a powerful moat built on brand and customer behavior. I can understand that. It fits my circle of competence, even if it looks like a tech company to others. I don't need to understand every detail of the engineering. I need to understand the behavior of the customer and the enduring power of the brand. That's the difference between buying into a technological trend and investing in a consumer products giant. Here's the thing about this circle of competence. You don't need to be brilliant at everything. You just need to be brilliant at understanding a few things and then have the discipline to stick to those few things. Define your circle of competence, no matter how small, and stay within it. That means saying no to 99% of ideas that come your way, no matter how exciting they sound or how much others are making from them. Charlie and I say no to almost everything. We don't try to know everything. We just try to recognize what we do know and, more importantly, what we don't know. And we avoid the latter like the plague. It's really quite simple, but it's incredibly powerful. You don't need fancy math or complicated financial models to invest successfully. In fact, complexity is often a mask for something you don't understand or something that's just not a good business. If you can't explain it simply to a bright 10-year-old, you probably don't understand it well enough to invest in it. Ben Graham taught me to look for things that were screamingly cheap, things that were nets with assets worth more than the market cap. That was simple. Later, when Charlie got me thinking about wonderful businesses, it was still simple. Look for durable competitive advantages, good management, and understandable products or services. Take Coca-Cola again. What do? They make a brown, sugary liquid and sell it globally. It's simple. You understand it. You can imagine people drinking it 50 years from now. That's the kind of business we like. Orse's Candies, a simple product, but with an incredible brand and taste. People buy it for gifts. They buy it to treat themselves. It tastes good and it makes people happy. That's a business you can understand year in and year out. It's not sexy. It's not complex, but it works and it endures. It's comforting in its predictability. And that's a powerful thing in the world of business and investing. So my advice to young investors, or anyone for that matter, is to cultivate intellectual humility. Know your limits. Don't feel pressured to have an opinion on everything. It's perfectly okay to say, I don't know. In fact, it's often the smartest thing you can say. Investing is about buying a part of a business, understanding what it's worth, and waiting for the market to recognize that. Speculating is about guessing what someone else will pay for it next week, purely based on price momentum. We are investors, not speculators, and that means we need to understand the underlying business, not just the stock ticker. This principle of staying within your circle applies not just to investing, but to running any business. Companies that try to be everything to everyone, that diversify into areas they don't understand, often run into trouble. Stick to your core competence. Do what you do best and do it better than anyone else. The truth is, human nature tends to chase fads, to follow the crowd, to want to get rich quick. But wealth, real wealth, is built slowly and deliberately by understanding value and having the patience to let it compound. Ignore the noise, ignore the headlines, focus on the fundamentals, the enduring qualities of a business. Now, look, I've been doing this for over 80 years, starting with my pay-per-view earnings and my first stock purchase when I was a boy. I'm 93 now, and I've seen a lot of market cycles, a lot of booms and busts, a lot of smart people doing dumb things, and a lot of ordinary people doing smart things. If I could give just a few pieces of advice, especially to the younger generations starting out, it would boil down to these simple truths, honed over decades of mistakes and successes. After all these years, here's what I know for certain. Investing success boils down to a few fundamental, almost boring principles. First, understand the stock is a piece of a business. Don't buy a stock, buy a business. Second, demand a margin of safety. Buy well below what you think it's worth to protect yourself from errors in judgment or unforeseen events. Third, find wonderful businesses with enduring competitive advantages run by honest, capable managers who are also great capital allocators. Fourth, be patient and let compounding work its magic over years and decades. And fifth, stick to what you understand. Know your circle of competence and don't stray outside it. I'm 93 now, and if I could tell young investors one thing, it's to start early, save diligently, and then practice extreme patience. Invest in yourself first, develop skills, read voraciously, and never ever bet against America. This country has an incredible track record of innovation, resilience, and wealth creation. We've faced challenges, and we always will, but the human spirit, the drive for progress, the free market system, these are powerful forces that have consistently led to growth and opportunity. I still live in the house I bought in 1958 for $31,500. I still drive myself to the office in Omaha every day. My office in Kiewit Plaza, where I've been for decades, is still where I spend my time reading and thinking. You don't need to live extravagantly to live a rich life in every sense of the word. A simple life focused on what truly matters, family, friends, learning, and contributing, is far more fulfilling than chasing material possessions. My diet of cherry Coke, C's peanut brittle, and McDonald's shows you don't need to be fancy to be happy. You don't need to be brilliant. You don't need inside information. You don't need to chase every hot tip or try to time the market. What you need is a sound intellectual framework, the emotional discipline to stick to it through thick and thin, and the patience to let your investments grow over decades. Just find good businesses, pay a fair price, and then sit on them like a faithful dog on a bone. That's how you get rich, slowly but surely, while you sleep. As my partner Charlie always says, all I want to know is where I'm going to die, so I'll never go there. In investing, that means focusing on avoiding stupid mistakes. Focus on avoiding the mistakes, and the successes will largely take care of themselves.